Dear clients, I'm Richard, Senior Dealer from Phillips CFD. Last week, several US and global equity benchmark indices were either hitting new highs or challenging their respective historical record levels, as investors acted bullishly upon a more dovish than expected message from the March FOMC meeting. In essence, the Fed statements triggered a softer US dollar, which sponsored a broad-based rally in a wide spectrum of asset classes, from equity to treasury, from euro to gold and copper. For instance, in equities, both the tech-heavy Nasdaq Composite Index and the Stoxx Euro 600 Index soared to within touching distance of their March 2000 high, erasing almost all losses since the internet bubble era. Global stocks also reacted strongly to the Fed's liquidity jab, with the MSCI All Country World Index enjoying its best weekly rally in nearly 2 years. However, from the economic perspective, data flows remain tepid, as disappointing manufacturing and construction numbers offset an otherwise healthy tape of labor market improvements. Well, lukewarm economic activity translates to an extended indulgence in the low interest rate environment, doesn't it? Seems like it for now, as past weeks of rate hike concern-driven volatility subside, as suggested by VIX, a common gauge of equity fear, which tumbled to the 13th handle from a high of 22 attained at the start of the year. Clearly, last week's FOMC meeting was key in orchestrating market directions. The outcome was a fine-tuning of the Fed statement that basically removed a rate hike timetable so as to allow more policy flexibility for the Fed to adjust in accordance to their economic growth projections, which they lowered from their December figures. Nevertheless, while investors continue to look forward to a favorable rate environment in the near term, it is also important, in my opinion, to stay vigilant. Fed's 2 steps forward, 1 step backward approach, as seen from removing anchor words such as considerable time and patient from past statements, only to fall back to open-ended catchphrase like won't tighten until it is reasonably confident, may unintentionally breed market disorientations, which could backfire against Fed's credibility in guiding markets going forward. In terms of cross-market actions, safe haven boats were lifted alongside equities on the back of Fed's reassurance of a slower trajectory of rate hikes. For example, Treasury debt rallied strongly, pushing yield on the 10-year Treasury note well below 2% once again. Gold also held on to recent gains to trade near a 2-week high on Friday and was headed for the biggest weekly jump since January after the Fed's cautionary statement over its rate hike path and US economic growth. On the other hand, the US dollar ended the week on a sour note after the Fed dampened investors' expectations of a June tightening. Looking ahead, we are taking heed of Fed's assessment of a more subdued outlook, and in particular, their expression of concern over the strength of the US dollar. Indeed, for companies in the benchmark S&P 500, that's a big headwind, because many are multinationals, and as a group, they derive almost half of their revenue from international markets. As such, the potential risk is that should the strong US dollar headwind materialize into a wave of weak earnings during the upcoming 1Q15 US earnings seasons, this may turn out to be a key risk-off event that will erode current sky-high investors' confidence. In view of the potential risk of weak 1Q15 earnings in the US, investors may consider using Phillips CFD to hedge their portfolios either through corresponding world indices CFDs or shorting the equities CFD. Alternatively, Investors who want to continue riding on this rally in the US may also consider using Philip CFD to capitalize on other trading opportunities. Clients may wish to note that Philip CFD is now giving 40% off commissions for 40 top traded counters. For more information on this, please visit www.philipcfd.com. Thank you for watching this week's Market Watch. Please subscribe to us on Philip Capital YouTube channel and Facebook. Tune in next week for more Market Watch videos.